Hello ladies and gentlemen, my name is Alex Petrescu and I welcome you today to my Finance and Accounting Education channel. After the midweek escapade which we had here on YouTube when I went and filmed a short video about tax havens on the Danube channel here in Vienna, I am back in my apartment. As usual, today we are going to have two topics. The first one will be an introduction to my latest course available on Patreon and Udemy, namely the course called Credits and Investments. And the second topic would be the fourth part actually of my commentary about savings and investments. Of course, I thought that this time it will be confusing because the course is about credit and investments, the commentary is about savings and investments, and the people might get confused. There is a clear differentiation, but there are also things which can be transferred from one, let's say, topic to another. The commentary on if you have already followed, the commentary on savings and investments focuses on personal wealth, so individuals, what can you do with your money. However, the course on credits and investments has a more corporate approach, how a company should evaluate the investments, and we are talking more about property, plant and equipment, I don't know, new production facilities, new divisions, things in this direction. So not securities or investing in financial instruments, and not for individuals. So those would be the differences between the two topics. However, before we start, please do not forget to support me if you like my channel, to hit like on these videos, to comment if you have something to say, if you would like to see something discussed more thoroughly, if you have something to add, if you want to contradict me on topics. Also to share it if you think somebody would be interested in my videos. And last but not least, the most important, please try to subscribe to this channel because it's helping me a lot. Other ways through which you can help me and I can also give you some benefits are first of all, you can create through eToro, you can create a trading account or securities account. You can buy their shares. We will talk today about the shares and bonds without commission, which is always a very good idea because no matter how often you do it, you save money, even if you buy shares, let's say once per year or once every few years, and so on and so forth. The second and the third options, you can help me with Amazon. You have two audibles for free, which you can get if you click the link below. So audiobooks, if you are into audiobooks, or alternatively, if you like, I also have a Kindle and I am downloading regularly books and reading from Kindle. You can get into the Kindle program and you can also help me through this. And last but not least, let's say the version which is helping you less and it's helping me more, and it might be the most expensive for you, is that I have an Amazon wish list on which you can find a lot of items that can help me improve my videos, a better webcam, video editing software, the latest version of Microsoft Office, a light system for my apartment. Today I think there is enough light in my apartment and everything is okay, but for the winter times, for when it's dark outside, the weather is not so good. A green screen which can help me have more dynamic videos and maybe standing and with a background and things like this, and even a mobile solution for filming these videos, namely a laptop, should you have the preference to help me in this way. On one hand, with most of the options you get also something, but I also can get to finance my so my channel and to keep it going for you guys if you like it. Now stepping right to the topics. First topic, I said introduction to the course Credits and Investments. It's already available on Patreon and Udemy. On Patreon you have a monthly subscription and you gain access to all my courses. the ones that I have already released. If you keep the subscription, you will also get access to the ones which I will release in the future. On Udemy, however, is a paper course, so you can select and pinpoint, I'm interested in this topic and that topic, and that's it. So in the course Credits and Investments, we are talking first about the financial management roles, or the, let's say, the roles that a CFO or a finance director has in a company. And we see about which of these roles, so what's the link between these roles and this course. Then we talk a little bit on how to evaluate an investment. Remember, we talk about capital expenditure, we talk about property, plant and equipment. We can also include intangibles, but this is not about financial assets, it's not about securities in this direction. Then we are going to talk about what a cash flow is, how to calculate the discounted cash flow, which is fundamental to evaluating investments. Of course, once we start with discounted cash flow, we also need to talk about the net present value, internal rate of return, and other factors which we need to take into consideration when evaluating an investment. Then alternatively, we have as you have seen, we talked about cash flow, so that's one of the, let's say, of the financial statements which we are using, so the formats which we are using for evaluating an investment. The alternative is the P&L, the classic profit and loss. Of course, there is a separate course called Business Cases, and there you can see in detail how to use the P&L structure. We talk about advantages, drawbacks, when to use the cash flow, when to use the P&L approach, what can be beneficial in each situation when using each and every one of them. When we are done with the investments, we talk about credits, leasing, so equipment and autos, and residual value. There are some clarifications here. Credits, first of all, we focus on fixed installments, but we have a discussion about payment at the beginning of the period or at the end of the period. For leasing or other types of credits that have residual value, there is a different discussion, and there are here some clarification, what should be included, what should be excluded. Leasings tend to be a little bit more complicated, as in you have an advanced payment, you have their VAT included. You can also have, if you talk about cars, a first time registration tax or something in this direction. You have this residual value, so the fixes are a little bit more complicated than in the situation when we are talking about regular credits. Then we are going to talk about Excel and payment tables, so the functions which you can use and how to apply them, what let's say factors you need to put in those formulas in order to get the correct calculations. And at the end we have let's say a discussion, a more relaxed discussion about accounting for investments and what investments mean. And we talk only not about what normal people understand by investment, but also what managers in a company might understand. And there is let's say the diversity of the views and understandings about investments can lead you into trouble or slow you down very much when you are doing anything related to this. You might from management you can have a task to draw an investment list or something like that, and you might discover that what they call investments is something else that somebody in finance and accounting, so FP&A or performance management specialist is calling investments. That being said, we are done with the course Credits and Investments, and which is oriented towards the technical part, towards the, let's say, the corporate part of credits and also investments. And we are jumping to our commentary about savings and investments, which is more dedicated to personal wealth, so actually providing you guys several alternatives that I consider worthy of presenting, through which you can not only maintain but potentially increase your wealth. The fourth part is called Let's Get Down to Business, because we reached after the other three parts. We reached the part where the things get really interesting, because we are going to talk today about shares and also about bonds. Bonds are not so interesting, but we are going to mention them. So shares. Shares are making you potentially owners of companies. They are the go-to option for educated investors. The story with the shares, if you remember from investment funds, I said that you buy investment fund units. The investment fund is pulling all the money from all the investors, and then it's distributing according to the risk level that the fund wants to take, and is distributing them and diversifying accordingly. For individuals, however, that is, unless you are extremely rich, for individuals that is not so easy. I'm giving you here an example. One Amazon share last Friday, so on 18th of June 2021, was costing $3,486,000. So let's presume you have $5,000 which you want to invest in shares. You can buy one Amazon share and then something else on the side. So you really don't have that much diversification. You don't have the possibility of going into multiple markets, going into multiple industries, and so on and so forth. However, you can have some risk mitigation just by the quality of the shares that you are buying. If you go for these blue chips, these are the large corporates that are listed, that they are here for many years. They are well known, their performance is well known, and this is how you can mitigate your risk. As I have said, for diversification, you always need to think industries, regions, developing, or emerging markets, advanced markets, and so on and so forth. However, do mind that diversification. So if you think share X will bring you a lot of gains in the next period, but however, you don't want to throw all your money on that share because if you want to reduce the risk, do mind the fact that diversification, so buying not only share X but also ABC, for example, will also reduce your gains. I mean, it's only natural. One big advantage is, and a few months ago, I think, or even more than a few months ago, maybe 1 year, I was reading an article saying that in general, the people that are doing well for themselves financially have shares. So whatever other versions you choose, investment funds, linked unit insurances, so insurance policies, even the third pillar of the pension system, so the private optional pensions, by cutting the middlemen, so the employees in that investment funds, the managers which needs to be paid as well, they need to gain a monthly salary. They also sometimes receive bonuses and so on and so forth. They might be not that smart in the decisions that they are making. They might be way too conservative and so on and so forth. So the people that in the end own shares are the ones that are getting the most benefits from securities for owning financial assets. Two ideas here with shares. There are companies which are paying absolutely no dividends because they are reinvesting a lot and they are developing, and there you gain wealth through share price increases on the stock exchange. However, if you are targeting a dividend yield, that means you want to receive money back throughout a year and to make a living out of it, you need to look at the dividend yield, of course. So the dividend yield is like an interest rate you see for each dollar or euro which you spend on buying a share, how many cents you get as a dividend. And you should favor, of course, the companies which are usually the ones which are mature, established and well known, which are paying higher dividend than the others. And however, the story is that if you are trying to make a living out of it, do not believe the people that say that they can live very easily from investing on the stock exchange, especially if you are not trading, so if you are not very good at let's say capturing all these daily fluctuations and making gains out of them, in order to live out of dividend income, so just from this dividend that you get from your shares, you really need a large portfolio. Yeah, so it's very easy. You will see dividend yields of 5, maybe 10% maximum if you are lucky, and if you just divide your annual salary needs or your annual income needs by this 5 and 10%, you'll get the order of how large your portfolio should be in order to reach that. So basically to have this source of passive income, which would be the only one, and so on and so forth. Then the question is, everybody's asking when to buy and what to buy. I have absolutely no answer for you in this regard, as in specific. I'm not going to give you a specific name of a share or an exact moment in time when to buy it, but I can give you broad recommendations in terms of what to buy if you are not into trading. So if you are not in I buy today and I sell tomorrow, I buy then again, and so on and so forth, so you want to keep them for a longer term. You need to think on what's going on in the world, in the economies, in the environment, and what will be here to stay or what has potential to develop a lot in the next 20-30 years, and so on. There are, besides reading a lot about companies and knowing which and so what they are doing, each and every one of them, especially the ones into which you want to invest, I recommend you to also check the sectors related analysis, because there you get informations that cover, like for example, an analysis which is saying what are the trends and the movements and where is the banking sector, for example, going in the next 20-30 years, and that might give you an idea. Is it a good investment to buy shares in banks and or in financial institutions, and so on and so forth. When to buy, that's very easy for if you are not like, so if you are like me and you cannot afford any, let's say, sophisticated instruments, you cannot do margin trading, which are anyway like bets, so it's gambling. You cannot do short selling, you cannot do all this or derivatives and all these sophisticated instruments. You don't have access to them. The best moment when you can buy, of course, there are programs which tell you to do regular savings and monthly savings and to buy like this. However, your better bet in this regard is to buy exactly when the crises are here. They might be local crises, there might be global crises, but that's the moment when you buy. If you check here, we have in the presentation, we have the New York Stock Exchange Composite Index since 2003, I think. So 18 years, quite a lot of years. The idea is that if you look at the trend is always growing. This is why I was saying before that in this article about the people that were doing good for themselves, owning shares was the go-to. The idea is that you reduce your risk at maximum if you somehow your portfolio, which is of course very difficult, if somehow your portfolio is matching the market, then you will move together with the market. There are nowadays also very popular these funds which are trading indexes, so they are trying to match the market, the composition of the market in terms of sectors and companies and so on and so forth. The trend is always up, but occasionally and for short periods of time you can have downturns. Here I have marked for New York and what's relevant, the crisis in 2008-2009 and the pandemic, so the financial crisis in 2008-2009 and the pandemic in the year 2020 around March, which were very good moments in time where we could buy shares. For the Brexit, I have here marked on this chart, which is the FTSE 100. So this is the index from the London Stock Exchange. I have marked with this red arrow. You can see the Brexit. Yeah, so Brexit was also a very good opportunity to buy shares. Some other advices about, so broad advices, you might already know some of them, you might have heard about them. When you have a portfolio of shares and you see red, so the prices are going down, it's not a loss until you decide to sell those shares with a loss. So try not to panic. It's the same with gains. So even if you see green, you mark your gains only when you sell the shares. Try not to panic if you are a long-term investor. So if you are in the storing business and not in the moving business. Also, not looking every day or during the day might help you. So you need not to worry about these fluctuations that are specific to very short periods of time and they have nothing behind them. So it's not like the companies are releasing financial statements on that. There are really news about sectors or specific companies that come every day. But however, it's on the stock exchange you have the demand and offer, and there can be ample variations and you cannot control them. So try not to look at them all the time and to panic. Also remember that you have no tax due on shares value increase, only when you sell it with a gain. When you sell them with a gain, however, you might be, according to the jurisdiction, you might need to pay capital gains tax on the dividends which are paid to you. Now bonds. With bond is very simple. You can a little bit diversify also in this direction. They have lower risk than shares because they are, let's say, for the companies which want to take more debt, they are debt instruments, so not equity instruments, and they should be also lower rewarded as the equity instruments. They have a fixed income usually in forms of a coupon which is paid, can be 2 times per year, 3 times per year, 4 times per year, or usually 1 time per year. They are in this money market area, so that's why they are diversification, so they are something else than shares. The coupons usually are a percentage of the nominal value. For example, you can have a 3,000 euro bond with a 3.5% coupon, that would be 79 euros or something like that, which you will get yearly. Usually they are issued by large entities, states, so entire countries, municipalities, so towns or cities, large public and private companies to find this is how they are financing their activities. They are used for diversification and reducing risk in a portfolio. However, you need to mind that if you have fluctuating interest rates, these are fixed income securities or fixed income assets, and if the interest rates are going up, you might not make that much gain from these bonds. Usually the coupons and the coupons value, so this percentage is usually also related to the rating of the bond. So some countries are AAA, some countries are BB, and so on and so forth. These large rating agencies are rating these instruments, and of course the higher the risk, the bigger the coupon should be. So it depends which strategy you have exactly in diversification and how much risk you want to take in your portfolio. And should you take less risk, of course you will have also less rewards. And if you take more risk, usually better rewards are possible. Then we are talking about these ratings, which I have already launched. From the first one, we talked about the bank current accounts and deposits. We talked about the investment funds, pension funds, third pillar, so the let's say the private optional one, insurance funds, so the classic, the life insurance, and insurance funds unit linked. Now we talk about shares. So from all the instruments that I have presented so far, let's say that the shares present the highest possible risk. So they get 5 stars. Anything can happen. Liquidity, they are pretty liquid. I didn't say that they are as liquid as the bank current account, so they are not getting 5 stars but 4. The reason is that once you put a sell order on the market, you usually need to wait a little bit till the shares are sold and the money transfer, so it might take up 1 to 3 days or something like that. So it's not like when you put your debit card in an ATM, you can immediately have access to your money. Yeah, that's why I gave them 4 stars. And rewards, of course, also 5 stars, the maximum possible. I told you, the people that are doing very well for themselves from investments usually are investing in shares. Then the bonds, they are of course less riskier, not as not that reduced as the bank deposits or the current accounts, but they are in line, let's say, with the other investment funds, pension funds. Of course, it depends. If you take a very low rating bond with a high coupon, then of course the risk is increased. Once again, I already said that somehow I need to take an average per each instrument and think how risky they are, and I cannot consider all the variations and all the strategy. Just like in investment funds, some are more aggressive and they are taking more risks, some are less, but somehow I need to deduct an average behavior. Then we have the liquidity. They are, let's say, a little bit less liquid than the shares, I said. The reason is that not all the bonds are listed on the stock exchange. Some are listed on the stock exchange just like the shares, and you can get the money in 2 or 3 days maybe, but not all. Sometimes they are just sold directly to individuals, for example, from states via the treasury, and you don't have a market, or you need to identify somebody who wants to buy them, and so on and so forth. And the rewards, also I give them like 2 stars. They should be a little bit better rewarded, and you should gain a little bit more than you get with a bank deposit, for example. That's why I thought that maybe if you have the same type of risk that is taken in insurance, or in a classical insurance, or in a pension fund, or in an investment fund, the rewards for the bonds are somewhere 2, maybe 3 stars, but not more than that. So they are not, let's say, crazy, bringing you crazy gains. Once again, thank you very much. This was my commentary today about savings and investments, focusing on shares and bonds. Please do not forget to support me, to subscribe to my channel, like, share and comment this video. Also, do not forget, if you want to support me, and also it's very helpful for yourself, you can open an eToro trading account through which you will pay absolutely no commissions, no fees for your trading. You can take the links from the Amazon, so the affiliate programs from Amazon. You can get 2 free audio books or audibles, or you can get into the Kindle program. And last but not least, there is this wish list from Amazon, which is helping me get technical items or software and hardware which can help me improve the quality of my videos. Once again, my name is Alex Petrescu, and thank you very much for watching this video on YouTube, and see you next time.